Geopolitical tensions are rising and commodity prices are moving higher. But how exactly are global conflicts pushing oil, gold, and copper upward? And it all starts thousands of miles away from Wall Street. Here's the part most investors miss. Commodity prices don't just move because of supply and demand. They move because of fear. And right now, geopolitical tensions are quietly reshaping the entire commodity landscape. But here's the real question. Are we at the beginning of a temporary spike or the early stage of a new commodity supercycle? Stay with me, because what's happening beneath the surface could impact your portfolio far more than the headlines suggest. Why geopolitics and commodities are best friends and worst enemies? Let's start simple. Commodities are physical. Oil, gold, wheat, copper, they come from the ground. They travel through ports. They move through pipelines. They cross borders. Now, imagine what happens when a shipping lane becomes unsafe. A major oil producer faces sanctions. A mining region shuts down. A food exporting country enters conflict. Suddenly, supply tightens. And when supply tightens, prices don't politely rise. They jump. Quick question. When you see oil spike 4% in a day, do you think traders are calmly running spreadsheets? No, they're pricing in uncertainty. And uncertainty moves markets faster than fundamentals. Oil, the first casualty of tension. Let's talk oil. Energy is usually the first commodity to react to geopolitical tension. Why? Because oil production is highly concentrated. The Middle East, Russia, key OPEC Plus members. When tensions rise in any of these regions, markets immediately start pricing in. Supply disruption, sanctions, transportation risk, production cuts. And here's the thing most people underestimate. Oil doesn't need supply to actually stop. It just needs traders to think it might. That expectation alone can push prices significantly higher. But oil isn't even the most interesting commodity right now. Wait until we talk about gold. Gold, the fear thermometer. If oil is about supply shock, gold is about psychological shock. Whenever geopolitical tensions rise, gold tends to catch a bid. Why? Because gold represents stability, neutral value, a hedge against systemic risk, protection against currency instability. When confidence drops, gold rises. And we've seen this pattern over and over again. Conflict headlines, stock volatility, bond yields fluctuate, gold rallies. But here's the twist most investors miss. Gold doesn't just respond to conflict. It responds to how central banks react to conflict. If geopolitical tensions slow growth, central banks may pause rate hikes or even cut rates. And lower real yields? That's rocket fuel for gold. Let me simplify this in one sentence. Geopolitical tension increases uncertainty. Uncertainty increases safe haven demand. Safe haven demand boosts gold. It's not magic, it's human behavior. Industrial metals, the silent movers. Now, here's where things get interesting. While oil and gold grab headlines, industrial metals like copper and aluminum are quietly reacting too, copper especially. Copper is used in infrastructure, defense equipment, energy grids, EVs, military hardware. So when geopolitical tensions increase, 1, governments increase defense spending. 2, infrastructure gets reshored. 3, supply chains get relocated. All of that increases demand for industrial metals. At the same time, mining operations in politically unstable regions face disruptions. Demand up, supply uncertain, price pressure builds. But there's one commodity that could be the biggest sleeper in geopolitical tensions: food, agricultural commodities, the underestimated risk. When conflict impacts major grain exporters, wheat, corn, soybeans, global food prices react fast. Food is politically sensitive. Countries don't wait around when supply is threatened. They stockpile. They restrict exports. They secure alternative suppliers. And that creates ripple effects across global markets. Higher food prices feed into inflation. Higher inflation pressures central banks. Higher policy uncertainty feeds into gold and currencies. See how it all connects? Commodities don't move in isolation. They move as a system. Let's zoom out. Geopolitical tension doesn't just affect producers, it affects transportation. If key shipping routes face risk, insurance costs spike, freight costs rise, delays increase. Energy transport becomes more expensive. That feeds directly into commodity prices. Even if production stays constant, transportation friction can push prices higher. It's like adding toll booths to global trade. Every extra friction point increases cost, and markets price that quickly. You might be thinking, okay, but haven't markets always dealt with conflict? Yes, but here's what's different today. Global supply chains are more interconnected. Energy transition policies are reshaping production. Strategic competition between major powers is intensifying. Countries are prioritizing economic security over efficiency. That last one is key. Efficiency kept commodity prices low for decades. Security is more expensive. Now let's address the big question. Are these geopolitical tensions creating short-term spikes, or are they laying the groundwork for a multi-year commodity uptrend? Some analysts argue that underinvestment in energy production, supply chain fragmentation, resource nationalism, increased defense spending, strategic stockpiling could create sustained upward pressure on commodities. If supply remains structurally tight while global demand continues, prices may not fully retrace. But here's the other side. If tensions ease or diplomacy stabilizes regions, risk premiums can unwind quickly. Commodity rallies built on fear can correct sharply when fear fades. That's why volatility is the only guaranteed constant. Let's bring this back to you. What does this mean for your portfolio? 1. Commodities often act as inflation hedges during geopolitical stress. 2. Energy stocks can benefit from higher oil prices. 3. Gold and precious metals may provide downside protection. 4. Industrial metals exposure could benefit from reshoring trends, but timing matters. Buying after a panic spike is different from accumulating during consolidation. There's one more layer to this story that most mainstream discussions ignore. Currency dynamics. Most global commodities are priced in US dollars, so when geopolitical tensions rise, the US dollar may strengthen as a safe haven, or it may weaken depending on domestic policy responses. If the dollar weakens while geopolitical tensions rise, that can amplify commodity price gains. If the dollar strengthens, it may offset some commodity upside. This interaction creates cross-market volatility. Commodities aren't just reacting to war headlines, they're reacting to currency shifts, bond markets, and central bank messaging. Here's the bottom line. Geopolitical tensions are increasing supply uncertainty, raising transportation and insurance costs, encouraging stockpiling, boosting defense and infrastructure demand, driving safe haven flows. And all of that is pushing commodity prices higher. But the bigger story isn't just fear, it's structural change. Globalization prioritized efficiency. The current environment prioritizes resilience, and resilience costs money, which means commodities may remain structurally supported longer than many expect. Now I want to hear from you. Do you think this is just another temporary spike in oil and gold? Or are we entering a longer-term commodity bull market driven by geopolitical realignment? Drop your thoughts in the comments. And if you found this breakdown helpful, make sure you subscribe, because the intersection of geopolitics and markets is only getting more important in 2026.